U.S. equity markets are about 90 minutes away from finally getting a chance to react to Friday's jobs report. Because remember, markets were closed on Friday when the jobs number came out. Joining us now with the preview of what the markets are going to do, Constance Hunter is Deputy Chief Investment Officer for AXA Investment Managers. And Larry Glazer is Managing Partner of Mayflower Advisors. Ladies and gentlemen, good to see you. So the number on Friday was extremely disappointing. We had job growth, but not nearly as much as folks expected. Constance, what does this mean? You're the Chief Investment Officer, right? What do you do here? Do you get worried about the possibility of a weaker economy than what you were thinking when you were making investment decisions?
Well, two things. One is the bond market was open on Friday, and we saw the 10-year come back down below 2.5%. And so when we think about what is going on for long-term rates, we have a very asymmetric situation. That is, more QE is unlikely to lower rates very much, but the economic situation and the problems in Europe are unlikely to cause rates to go up very much. But as far as the economy, I think from the market's perspective, we had what I would call sizzle to fizzle, right? Everybody was putting all this hope in the jobs, and they were just going to keep going up, keep going up. If you look at the last 2 quarters, jobs grew 205,000 a month. That's consistent with where initial claims are. That is consistent with a 2.5% growth rate. So this, and it's a volatile number.
Does this number kill that, or do you just look past it and say it's an outlier?
Looking into the number and looking into some of the details, it makes you question, are we heading a soft patch? How much was brought forward because of the warm weather? Retailers hiring because they had more traffic because the weather was warmer. And it's one of those things we have to wait and see. But I think making, an entire investment decision based on one number is a little unwise.
Yeah. Okay, Larry, how about you? Weigh in. Same question.
Sure. Well, despite that weak jobs report, I think it's important for investors not to overreact to that information and to keep it in the proper perspective. After all, we know that the real test is going to be corporate earnings. It's not the jobs report. It's not Chinese inflation data. It's what happens in corporate America. How does corporate America deal with this? We did see that seasonal slowdown in the jobs report. And the question is, how is that going to play out in corporate earnings?
And Larry, haven't estimates been coming down? And considering the big rally that we've had, does that put us at risk?
Sure. I think, the market was clearly getting frothy. It was clearly getting complacent. It was getting sloppy. When you see a Q1 like we did, investors get very complacent. You saw the VIX. You saw investors' intelligence. All signs of the market was getting a little bit soft going into that. I think you need to be vigilant going into corporate earnings season, but still looking for opportunities on weakness if you do see those disappointments.
How do you feel about earnings season? Is it a make or break? How much is it going to drive asset prices?
I think it will drive stock prices significantly. I think you could see stocks come off. But from a bond investor's perspective, what we're looking at is what's going on with the cash flows. And this is where our credit selection comes in, right? So we look at the macro to determine where we are in the yield curve, what's going on with interest rates. But in terms of the credit selection, there's still amazing credits out there. And I think it puts the attractiveness of bonds relative to stocks still on the map.
How risky do you go?
How risky do you go in terms of credit?
Asset quality,
Well, it depends on what every investor wants a different thing in their portfolio, right? So in our allocations that are high yield or short duration high yield, those are investors that want a riskier portfolio. And so you're very selective when you go down the credit curve. But if you do it selectively, you can pick up a lot of return for your clients.
Larry, I was so relieved that the U.S. markets were moving on U.S. information. We had been so beholden to every single arcane piece of data out of various European countries and auctions, this, that, and every other week. It feels like, though, we've gone from being a stock market that was wondering whether Italian yields would rise above 7% to now a market that's dependent on whether or not Chinese growth is going to fall below 7%. Am I making too much of that? Is that a crucial question or not?
No, I don't think you are making too much of it. And I think, again, at the end of the day, if you look, many areas of the U.S. market were getting a little bit picked over because investors were looking for that safe trade. They were looking for that dividend play, high yield, anything that was an equity substitute. In fact, I would argue that you want to confront your fears here and you want to look into the abyss. And if you see Europe as the fear and Europe as the uncertainty, maybe you take
advantage. What about China?
We saw a lot of weakness in Europe last week. China, it's the global play, right? Everyone's looking at the Chinese data last night. They're trying to look into it. I got to tell you, you can look at that data all you want, and you can't tell anything from it because the data is so manufactured. So rather than look at that Chinese data and try to make a determination, I think investors need to have a strong stomach, take a deep breath, go for a walk around, and look for some opportunities on weakness that we're seeing this week in corporate
China,
earnings.
Constance?
Pretty closely. We have a big event in China this year, which is the leadership change. And so
every 10 years, it's a big deal. And this one seems to be tumultuous already.
Well, and what you have it pushing up against is the U.S. leadership change. So you have all this rhetoric coming on both sides. But within, and obviously the Bo Xi event in China, and the changes in Chongqing, they fired more people in Chongqing. They're really trying to make a statement. But I think on balance, the leadership in China really wants to keep things on a smooth track. So I don't think they're going to be doing any wild policy moves, either tightening or stimulus.
Okay. Steady policy. Got it. Constance, Larry, thank you so much.